I was asked to be on the Financial Crisis Inquiry Commission by John Boehner, who was then the Republican leader in the House. And he, I assume, had been told by other Republican congressmen that they thought I had some sensible ideas about what had happened in the financial markets, and that I would be a good member of this commission. I would be a sound analyst for what actually happened in the financial crisis. So I think I think the decision was made sometime in early July of 2009. And the members of the commission were announced. There were 6 Democrats and 4 Republicans. That's because the Democrats at that time controlled Congress. But there were four Republicans, and we began our work probably in late August or early September. Dodd-Frank was adopted in July of 2010. The commission was still working on its study, its analysis, in July of 2010, so they didn't wait for the commission to tell them what caused the financial crisis. They went ahead and adopted the law that was supposed to be the remedy for whatever caused the financial crisis without waiting to hear what the commission they'd appointed said caused the financial crisis. So that was one of the silly things about this whole affair. Congress would not wait to find out what the facts were before they went ahead and adopted legislation. That is unfortunate, but on the other hand, I don't believe that the commission was ever going to say anything that was different from what the people who were drafting the Dodd-Frank Act wanted them to say. And what Senator Dodd and Congressman Frank wanted was a statement by the commission that more regulation was necessary, that the reason we had a financial crisis is that the financial institutions in this country, the banks, the investment banks, and other financial institutions were not sufficiently regulated, and we needed a much tougher regulatory regime in order to prevent the next financial crisis. That's what Dodd-Frank is based on. It was adopted in July of 2010, and oddly enough, when the commission issued its report, it provided down-the-line support for that conclusion by Congress about 6 months earlier. The commission's report came out in January of 2011. I dissented from it, and I dissented because it was clear to me that the commission was not even looking at alternative explanations of any kind for the financial crisis other than the only explanation they would be willing to accept is that the financial crisis could have been prevented if there only had been more regulation of banks and insurance firms, securities firms, lots of other financial institutions. And that's what basically the Dodd-Frank Act is based on, the notion that we needed in this country a much, much tougher financial regulatory regime. There were 2 hearings held on this subject, one in the Senate Banking Committee and one in the House Financial Services Committee. I would say that of all the testimony, there was a total of maybe 5 hours. About 3 hours, maybe 3.5 hours in the House Financial Services Committee, and maybe as much as 1.5 hours in the Senate Banking Committee. In other words, Congress didn't pay very much attention at all. And after all, why would they? They'd already adopted the act, the Dodd-Frank Act. They had done the damage that they were intending to do, as far as I'm concerned, and to reprise what happened at the commission was not on their agenda, especially because I was going to be very outspoken about what a poor quality report this commission had turned out. Mortgage-backed securities are themselves not a problem, but the way they operate in the market at certain times can be a problem. If we take, for example, what happened between 1997 and 2007, that was a period when we had an enormous bubble develop in the U.S. housing market. Housing prices kept rising, and in fact, over that period, they almost doubled. That's unprecedented. We've never had a period of 10 years during which housing prices in this country have doubled. Now, what happens when housing prices increase so substantially? The most important thing that occurs is that they suppress delinquencies and defaults, because people who can't afford to meet their mortgage obligations can always refinance because the house has now risen in value. Or if they don't even refinance, they just give the house back to the bank. The bank does not lose anything because it can ordinarily sell the house for more than the mortgage price, and so it isn't reported as a default. Now, the effect of this in an environment where mortgage-backed securities are being sold is that low-quality securities, which usually carry a high yield, subprime securities, for example, subprime mortgages with securities based on these subprime mortgages, usually carry a very high yield because they're considered risky. But what investors are seeing when a bubble is developing is that these are high-yielding securities, but very few losses associated with them because of the bubble, because of the growth of this bubble. So that's the way that mortgage-backed securities could become a problem in certain circumstances. And the worst kind of circumstance is the one that we had just before the financial crisis in 2008, because we had this enormously long 10-year bubble. And by the fifth or sixth year, investors were getting pretty excited about what they were seeing in mortgage-backed securities. High yields with very few losses. And they wanted to add those securities to their portfolios. That is what was responsible for the big boom in privately offered, privately sold, privately distributed subprime mortgages through mortgage-backed securities. A subprime mortgage has a very distinct definition, and that is it is a mortgage made to a borrower who has a blemished credit record. In the United States, we use something called FICO scores, F-I-C-O. It's a contraction of Fair Isaac, which is a company that made up these scores. And those scores measure the quality of a person's credit rating. A FICO score of less than 660 means that you have a blemished credit record. You have not been meeting your obligations either on your credit card or your car loan or maybe a store credit or anything else. There are certain things that you have failed to do which indicate that you have a low credit rating. A subprime mortgage is one that is made to a person with a credit rating on the FICO score below 660. Now, there are other reasons why mortgages are not good, high-quality mortgages. There might be, for example, a low down payment. There might not be any amortization. The mortgage might only require the payment of interest. There could be a lack of adequate documentation, a lack of assurance that the person who has taken out the mortgage will actually occupy the home. All of these are things that are important in determining the quality of a mortgage and make it more risky than the prime mortgage. So when I say that there are subprime mortgages, I'm referring to mortgages made to people who already have blemished credit records. And when I say a mortgage is risky or low quality, I'm really referring to the kind of mortgage it is rather than to the borrower. So the same mortgage can be both subprime and low quality, but in fact, in our financial crisis here in the United States, the mortgages tended to be subprime on one side and low quality on another. So we had two different categories of mortgages that turned out to be weak and risky when the financial crisis came around. Now, if we're talking about non-traditional mortgages, we're talking about two kinds of mortgages. That is the subprime mortgage and what is known frequently in the field as the Alt-A mortgage, or I will just call it the low quality or risky mortgage. Both of them together are frequently called non-traditional mortgages because traditionally mortgages had certain quality levels. They were made to people who had good payment records. In other words, they had FICO scores above 660. They didn't have blemished payment records. And there was usually a good down payment. There was a relatively low debt-to-income ratio. And there was good documentation for the loan. Those are some of the very basic things that would exist in a traditional mortgage. A non-traditional mortgage would be lacking some of those things. And in the case of what happened in the United States, non-traditional mortgages became very, very popular because of government policy. Government policy actually induced some of the major players in the housing market, principally Fannie Mae and Freddie Mac, to seek out non-traditional mortgages or subprime mortgages. And eventually, by 2008, just before the financial crisis occurred, Fannie Mae and Freddie Mac and a number of other government agencies, all functioning in about the same way, but Fannie and Freddie were certainly the largest and most important, had produced about 19.2, and were holding on their balance sheets or guaranteeing 19.2 million non-traditional mortgages, subprime and otherwise risky loans. And the total of such mortgages outstanding at that time was 27 million, which would be about half of all mortgages in the United States. So my view is that the government's housing policy, which induced Fannie Mae and Freddie Mac to take these kinds of risks, to buy these kinds of mortgages, was the cause of the financial crisis, because they were the ones who caused the production of, bought most of the very weak mortgages that came into the market. 19.2 million for Fannie and Freddie and other government agencies, and then about 7.8 million for the private sector. So as between the two of them, it's obvious to me that the cause of the financial crisis comes primarily from government housing policy and not from the banks. And we can see this too by looking at the dates in which each of these parties got involved in non-traditional mortgages. Between about 1992 and 2002, the subprime or non-traditional mortgage market was only, in any substantial sense, run by Fannie Mae and Freddie Mac. And why did they do this? They did this because the government had adopted in 1992 something called the Affordable Housing Requirements, which required Fannie and Freddie, when they bought mortgages from banks and other originators, and that's what they did. That was their business. They bought mortgages, bought residential mortgages, and only residential mortgages, from originators like banks and brokers and that sort of thing. When they bought those mortgages, 30% of those mortgages had to be made to people who were at or below the median income in the communities where they lived. Now, it's pretty easy for anyone to find a prime mortgage in among people who are at or below the median income, when you don't have a quota that is greater than the number of such mortgages are likely to be. And 30% is about the level at which Fannie and Freddie could be sure to find prime mortgages among people who were at or below the median income in the areas that they were buying these mortgages from. But over time, the Department of Housing and Urban Development, what we call HUD, and that is the cabinet department that is in charge of the housing field and other areas of the financial economy, but principally housing. HUD made the affordable housing requirements tighter. They raised them to 45% in about 1995, and then to 50% by the year 2000. That is, of all the mortgages Fannie and Freddie bought, 50% had to be made to people at or below the median income. And then by 2007, the Bush administration, which was then in office, raised that number to 55%. So when you think about it, if it's not hard to find prime mortgages when 30% of the mortgages have to be bought from people at or below the median income, you can see how much tougher it gets when it gets to 50%. That means half of all the mortgages you buy have to be to people below the median income. And when it gets to 55%, it's harder still. So as those requirements went up, Fannie and Freddie were compelled to meet these quotas every year. And that meant that they had to substantially reduce their underwriting requirements. Fannie, for example, by the year 2000, was already offering mortgages with no down payment at all. And that's a clear indication that they were trying to find borrowers who could afford to pay something on a loan, but these were not people who could come up with a down payment and thus could not be responsible for what would be a prime mortgage. And that was by the year 2000. So by the year 2002, which is 10 years after these affordable housing requirements were put in, Fannie and Freddie had already bought well over $1 trillion in subprime and other low-quality loans. It was in 2002, for the first time, that the banking system passed $100 billion. That's about a tenth of what Fannie and Freddie had already produced in their private securitization of subprime and other non-traditional mortgages. So it was Fannie and Freddie that really was in the business for 10 years before the private sector actually got involved. And for the next few years, the private sector did produce a lot of those mortgages. They securitized many of them, and they held many of them, and distributed the rest to investors around the world who were very eager to have these mortgages because they seemed to be paying very high yields, and because they were the product of a housing bubble, were not at the same time showing very many delinquencies and defaults because housing prices were rising. So when you look at what happened with non-traditional mortgages, it began in 1992 with the affordable housing requirements. It gradually grew over time as those requirements were tightened up and made more difficult for Fannie and Freddie to meet, tightened up and made more difficult by the Department of Housing and Urban Development. Then by the mid-2000s, the private sector got involved because these looked like very good investments. And so by 2008, we had in our financial system, and this is almost impossible to imagine, but there it is, 27 million subprime and other low-quality mortgages, and that was half of all mortgages. Why did we have this financial panic, and why did it occur in 2008? And the answer to that has much to do with what happened in the mortgage market. Because we had 27 million subprime and other low-quality loans. When they started to fail in 2008, 2007, and early 2008, they failed in unprecedented numbers. The investors in mortgage-backed securities got frightened because they'd never seen this rate of default, delinquency and default. And so they abandoned the market completely. When they did that, the value of mortgage-backed securities fell almost to nothing because there were no buyers. Under what was called mark-to-market accounting, all of these institutions were required to write their assets down to what the market was willing to pay for them. And since there were no buyers, the market wasn't willing to pay anything for them, or at least anything other than a distressed price that vultures were willing to pay at that time. So when they wrote down their assets in that way, their leverage got even higher, and it became questionable whether they were solvent or stable. And as a result, investors would no longer want to keep their money with those institutions. They began to pull their money out of, first, Bear Stearns, which was the most heavily committed to the residential mortgage business, then Lehman Brothers, and then they started to look at Merrill Lynch and so on and so forth. This is because of the very, very unusual circumstances at the time, with 27 million of these subprime and other low-quality mortgages in the market, and what we would call mark-to-market accounting, which is an accounting convention that was applicable not only to banks but also to non-bank financial institutions. Actually, I look at Barney Frank in two ways. He was, for the entire time that affordable housing requirements were in effect, he was the principal cheerleader for affordable housing requirements. And not just that, for any one of the government's policies that made more mortgage money available to low-income borrowers. The other area where this is true was something called the Community Reinvestment Act, which applied to banks and required banks in the areas that they serve to make loans to people in the community, and especially loans to people whose credit ratings were weak, but the banks had to show that they were making these loans even so, because that was the government requirement. Now, I don't think that the Community Reinvestment Act was a major factor. It was done, same general idea, and that is that you don't really care about the quality of the borrower, or you want to make sure that the person who is the borrower is a person who is did not have access to mortgage credit before. That was what was underlying the affordable housing requirements, and that's what was underlying the CRA. But that was something that Barney Frank took as one of his principal objectives during his entire career in Congress, was to make sure that low-income people got mortgage credit. Now, this is a worthwhile thing to be for. But it is not a good idea to do this if it means that you have to, that the result is reducing mortgage underwriting standards so that the mortgages that are in the financial system are poor quality mortgages that are liable to failure. There are lots of other ways that the government could help low-income people to become homeowners, if that's what we wanted. But the way they chose to do it was a hidden way. It was not clear what was happening. No one was following it. No one was given responsibility for it. And as a result, we ended up with 27 million subprime and other very low-quality mortgages, which caused the financial crisis when they began to fail in unprecedented numbers. And Barney Frank, I see, is responsible for that. He was the one who was the principal defender of those kinds of policies and of Fannie Mae and Freddie Mac for most of the time that they were in existence. and he was in Congress. Now, in 2007, when he became chairman of the House Financial Services Committee after the election of 2006, he did reverse his field. He did say at that time that it was necessary to regulate them very strictly. Before that time, he was saying things like, well, I think we ought to roll the dice for more risk-taking on these subsidized mortgages, because I think that would be a good policy for this country. He said that in 2003. By 2007, he had realized that he had made a big mistake, and that's to his credit. When you make a mistake, you can reverse that mistake, and he did. He cooperated with the Bush administration and got some very tough regulation of Fannie Mae and Freddie Mac. But unfortunately, by that time, it was just too late. They had already acquired so many low-quality and other weak mortgages, and they had already filled the financial system with so many low-quality and weak mortgages that I'm afraid the financial system simply could not survive the deflation of that bubble and the huge number of delinquencies and defaults that occurred. So he deserves some credit for changing his mind, but he deserves a lot of the blame for the fact that we had a financial crisis. Yeah, Bush, actually, he's also a somewhat conflicted figure because as president, he attempted to get much stronger regulation of Fannie and Freddie between, I think it would probably have started in about 2003 and then all the way through the end of his presidency in 2008. He did try to get tougher regulation of Fannie and Freddie. The trouble is that he did not at the same time call up his Secretary of Housing and Urban Development and say, what's this I hear about you're making so many, or forcing Fannie Mae and Freddie Mac to make so many subprime and other low-quality loans. It's possible that he didn't know about it because, as I have said, the information about what Fannie and Freddie were doing was very, very closely held, largely among the companies themselves and not available to people in the market. So it's entirely possible Bush had no idea what Fannie and Freddie were doing under the lash of HUD. So I think he might escape some of the blame here, but if we are going to blame the Democrats, as I do, for starting this process in 1992, I think we also have to blame Bush for continuing it all the way through his presidency. Now, in 2007, his Secretary of the Treasury, negotiating with Barney Frank, did produce a good regulatory statute for Fannie and Freddie, something that the Bush administration had wanted from about 2003 on, but I think at that point it was just too late. Well, Bear Stearns was rescued in March of 2008. And to me, that was the original sin. The U.S. government had never before rescued an institution that was not a commercial bank. Now, why were commercial banks rescued? The reason, of course, is we had deposit insurance. There was some government responsibility for it. Banks are very important in the financial system, and there was a fear among the regulators that the failure of a bank, a commercial bank, could cause a kind of a systemic breakdown in the economy. That is, the entire system would come to a halt. But no one ever thought that about an investment bank like Bear Stearns. It was only about $450 billion. It's a big institution. I'm not saying it was a small institution, but no one ever thought that there was ever any government responsibility for an investment bank. And yet, for reasons that are still not clear to me, the government, for the first time, decided to rescue Bear Stearns by providing about $30 billion to J.P. Morgan Chase, one of the very largest banks, to induce it to acquire Bear Stearns, which it did. Now, what signals did that send to the market? If you think about it, if you're a participant in the market, if you're an investor, if you're a company, that sends some very dangerous signals. One is that just about every other large financial institution, at least larger than Bear Stearns, is going to be rescued. Because if the United States government rescued Bear Stearns, why wouldn't it rescue anyone else? And so, as losses continued to mount in the market, a large number of organizations that should have been selling stock and raising new capital to protect themselves, to make themselves more solvent, look more solvent, and actually be more solvent, decided not to do it. They decided not to do it for two reasons. One is they thought that their investors their creditors would stay with them even if they looked weak, because the creditors would be protected if the company actually failed. So with the creditors being protected, they wouldn't run from the company, and therefore there wasn't really that much need to add to the company's capital. In addition, and this is probably the second reason, since share prices had fallen so substantially because of the panic, for companies to sell shares and thus raise their capital, reduce their leverage is another way to put it, that would mean diluting their shareholders tremendously, and companies do not want to do that. So they decided not to bulk up in terms of their capital because they figured that the creditors would stay with them anyway, and they didn't want to dilute their shareholders. That's the way I think the Lehman Brothers of the world, the Goldman Sachses, the Merrill Lynches, that's how they probably thought about this. They did not raise a lot of capital. And so that left them in a very weak position when the panic really ensued after Lehman Brothers was allowed to fail. Now, why was Lehman Brothers allowed to fail? That's a real puzzle, too. I don't think there is a good reason for that. Once they had rescued Bear Stearns, it was perfectly clear that they had sent a signal to the market that every large financial institution would be rescued in the future. So, of course, when the time came that Lehman Brothers was in trouble and it wasn't rescued, people were absolutely shocked. They had been making decisions, lending money to one another, based on the idea that they were all going to be protected by the government. And suddenly the government reversed policy completely and did not rescue one of the very large institutions. That, of course, just made the panic much worse, because at that point nobody knew who was solvent, who could be lent to, who was protected by the government, and who was not. And as a result, all these financial institutions, including the major banks in the world, just hoarded cash. So they would have the cash in case their depositors came to them and said they wanted their money back. And it was the hoarding of cash by these institutions that caused us to think of this as a financial crisis, as an unprecedented financial event. But there were other effects also of the rescue of Bear Stearns. Once people thought that the major banks and other financial institutions would be rescued, they didn't take losses on the obligations, the securities that they were holding. For example, there was a money market mutual fund called the Prime Reserve Fund. The Prime Reserve Fund was holding a large amount of commercial paper, that's short-term obligations, of Lehman Brothers. Now, as Lehman Brothers looked weaker and weaker, the sensible thing for them to do would have been to sell that commercial paper. They would have taken a loss on it, but it would have been a relatively small loss because nobody actually thought that Lehman Brothers was going to fail. So the loss would have been relatively small. Unfortunately, they didn't. And so when Lehman Brothers actually went into bankruptcy, they suffered, that is the prime reserve fund, suffered a huge loss. And as a result of that, they did something that mutual funds have almost never done. They broke the buck, what is called broke the buck. That is to say, their shares were no longer held at $1 a share. All these money market mutual funds had followed the convention of making sure that any time a shareholder put his shares back to the fund, he would get $1 for each share. But the prime reserve fund couldn't do that after it suffered that huge loss on the Lehman commercial paper. It broke the buck, and that started a panic in the mutual fund business, and a lot of people investors withdrew their funds from other mutual funds. Now, the Treasury stepped in and had to rescue the mutual funds. But the point is that all of that comes from the decision that was made to rescue Bear Stearns, and what I have called the original sin. If that hadn't happened, if Bear Stearns had been allowed to fail, there would have been disruption, certainly, in the market, and a lot of people would have suffered some losses. But we wouldn't have had a financial crisis. We would have had a lot of people licking their wounds, but not a financial crisis. It was the saving of Bear Stearns and then the decision, when the time came, not to rescue Lehman Brothers, that really caused the financial panic. Well, the government took them over in 2008, just a week before the financial crisis began, and has been operating them ever since on a much more conservative basis. That is to say, the mortgages that they have been buying have been much, much better quality mortgages. The agency that controls them now, the Federal Housing Finance Agency, has insisted that the affordable housing loans that they buy are only as many as the market is actually producing, so that they are not under any particular quota to buy affordable housing loans. That part of the law has not been repealed, but it's no longer having the same effect on Fannie Mae and Freddie Mac. But the losses that they suffered are now coming in, and because they made so many poor quality mortgages under the requirements of affordable housing, they are suffering losses week after week, month after month, year after year. We've now provided about $160 billion to them to keep them solvent, because their losses have been about $160 billion. Their regulator estimates that the losses will probably be somewhere between $200 and $300 billion when all is said and done. Maybe, could be more, could be less, but that's a very substantial cost for the shareholders in this country. I'm sorry, for the taxpayers in this country. Not the shareholders of Fannie and Freddie are finished. They don't have anything. They're down for 3 or 4 cents each. But the taxpayers in this country are ultimately going to have to pay that bill. $200 or $300 billion. Credit default swaps are actually a very valuable instruments for the purpose of risk management. And one of the things that is so surprising to me is that everyone talks about the importance of risk management, making sure that financial institutions are aware of the risks that they are taking and reduce their risks where possible. And credit default swaps are one of the most efficient instruments for doing exactly that. A credit default swap is really not much different from an insurance policy. Where they exist, they are simply a contractual agreement between two parties. And one party says to the other, I will protect you against any losses that you suffer because of the default of some third party in paying an obligation to you. That's all a credit default swap is. And the party that is protected by the swap pays a premium, what is called a premium, to the company offering the protection. Very, very simple idea. Of course, there are many complex contracts that are necessary to make the system work, but it's a relatively simple idea. It had absolutely nothing to do with the financial crisis, except in one respect, and that is, it may well be that our regulators did not understand that credit default swaps were not dangerous instruments. They may have been carried away by certain things that people said about credit default swaps that turned out not to be accurate. And I say not to be accurate because I look at what happened after the failure of Lehman Brothers, and that is the moment that most people look at as the event that triggered the financial crisis. It was Lehman's failure that caused other financial institutions to stop lending to one another. Well, Lehman was a huge player in the credit default swap market. And so one would expect, because they had both promised to reimburse others and bought protection from others, and because many people had bought protection, as it is called, on Lehman Brothers itself, that Lehman's failure would cause an enormous disruption of the credit default swap market. It didn't. There was no effect on the credit default swap market of any detectable kind. The credit default swaps that had been written on Lehman itself were settled 5 weeks after its default in an auction process that is used in the business. And for $6 billion that was exchanged among several hundred companies. And that settled all of the credit default swaps on Lehman itself, which was a $600 billion company when it failed. And then the credit default swaps on which Lehman was involved in one way or another, there were 900,000 of those. Some of them are still in the bankruptcy procedure, and many of them were terminated immediately, which is part of the credit default swap process. But there is no indication at all that the people who had entered into credit default swaps, either protected by Lehman or protecting Lehman, or protected by an agreement of some kind with Lehman, ever encountered any substantial financial reverses. There were no failures of any company that had credit default swap relationships with Lehman Brothers. And what happens, it's very, very simple actually, what happens when a company fails and there are a lot of credit default swaps written on that company, as long as the institutions that have written the credit default swaps don't themselves fail, it's a very easy process. Those companies then pay the companies that they had promised to protect, and that settles it. It's just a movement of funds from one group to another group. It doesn't increase in any way the total number of losses involved. The only loss is the loss on that particular company that failed and its various obligations. So although the numbers that are quoted frequently for credit default swaps, $60 or $80 trillion, things like that, are true in one sense. There's a lot of double counting in those numbers, and the actual losses when a default occurs are only the amount of default on a particular instrument that has been issued by a company that is protected by credit default swaps. It does not multiply through the economy as a whole. So I don't believe that credit default swaps were any kind of problem in the financial crisis. And when you listen to most people who are talking about credit default swaps, they cite only one company, and that is AIG. AIG did get into trouble writing credit default swaps because they did not hedge their obligation in any way. They took only one side of the obligation. They protected other companies. Most other players in the market hedge their obligations so that if you write protection against the default of some company, you then hedge your risk by buying protection from another company so that just in case you actually have to pay up, someone is going to at least share part of that burden with you. AIG did not do that. They just took one side of that obligation, and that is what caused them the difficulties. So if we are going to say that we have to do something to regulate this market because of the failure of one company to act properly in its dealings in that market, well, it's kind of like saying if one company makes some bad loans, we ought to have the government come in and regulate all lending. That isn't the way we do these things. The way it was done, of course, the way it should be done is we should understand what actually happened and then determine whether there really is any need for government regulation. That isn't how it worked. People started panicking about credit default swaps before they understood what they were. And in the end, the Dodd-Frank Act adopted an enormously complicated regulatory process for derivatives as a whole and credit default swaps in particular, on the basis of a great deal of ignorance about the kind of problems that they caused. When someone speaks of an over-the-counter derivative, they're talking about something that is not traded on a market and not cleared through a clearinghouse of some kind. Now, the derivatives that we might be talking about would be, for example, interest rate swaps. Those are called derivatives. What happens in an interest rate swap is that a company that is getting, because of the nature of its business, is getting fixed income payments of some kind, but doesn't like the risk of getting only a fixed payment, say a 5% payment, over a period of time, actually thinks that interest rates are going to start fluctuating, so it goes out and tries to find someone that will swap a floating rate of interest with a fixed rate of interest. And there are many other companies out in the market that get floating rates of interest, and they, for whatever reason, want fixed rates of interest, and that is traded or swapped between the two. And there's frequently an intermediary, a company in the middle, a bank or a securities firm of some kind, and they find the fixed derivative company, the one that, say, wants to get out of fixed interest rates, and they find the one on the other side, and they get paid a commission for doing that brokerage function. They put them together, and then after that, the two companies exchange over a period of time on a notional amount. That is an amount that they just select, $100 million, for example. And one company will say to the other, I will pay you 5% on $100 million. There's obviously no actual $100 million. It is just what is called a notional amount. But the other party says, okay, on $100 million, I will pay you a floating rate of interest based on some index like the London Interbank Offered Rate, and maybe I'll pay you 3% over the LIBOR rate, and they will exchange that way. And at some time, the company that is paying fixed is in the money, in the sense that they are paying less than they would be paying if they had a floating rate, and so they are getting back for their 5%, 6% from the other party, and then interest rates reverse. And at some point, the other party that is paying the floating rate is in the money. So that's a very simple example of one kind of derivative. But the one that has caused most of the difficulty, that has attracted most of the attention, is the credit default swap. And the reason for that is that actually there's a lot of real money that passes back and forth when a default has occurred. In the interest rate case, of course, it's just the interest on the $100 million notional amount. But in the credit default swap case, if $100 million is the notional amount and a $100 million obligation defaults, someone actually has to pay $100 million. The one who has written protection saying that it will guarantee or ensure the loss of some other party of as much as $100 million. So that can be a significant amount. The important thing to understand, however, is that everyone who has that kind of obligation has hedged its obligation in some way, has bought protection for itself, so that kind of very large obligation is not likely for any company to have to undertake. And it is a very interesting and important fact that the credit default swap market, the derivatives market in general, but the credit default swap market in particular, kept operating all through the financial crisis. When other problems were arising, when companies weren't lending to one another, when there was a panic in the market, all of that existed at the time, but the credit default swap market continued to function. A repurchase agreement is a secured loan. And it sounds complicated, but it's very simple. What would happen is that a company that wants to borrow some money has on its balance sheet a security, perhaps, maybe mortgage-backed security, a privately issued mortgage-backed security, or maybe a government mortgage-backed security. And it says to a potential lender, I will sell you my portfolio, or this number of mortgage-backed securities, we'll say $100 million of my mortgage-backed securities. You will pay me $100 million for that, and then I have the right within a certain period of time, according to our contract, to buy back the $100 million that I sold to you, not only for $100 million, but then for a certain additional amount, which turns out to be interest. So what it is a secured loan. And although it's called a repurchase agreement, it is a very, very simple way of companies borrowing unsecured loans and getting protection against default by the fact that the lending company usually has collateral that is very liquid and easy to sell in case the company that it has lent to actually does default. Ending mark-to-market accounting is a partial solution. It is not the only solution, but it does act in a very, what we call, pro-cyclical way when the market is going down. When prices are falling, mark-to-market accounting makes financial institutions look weaker and weaker and weaker as the market falls in value, and as their values fall, mark-to-market accounting keeps causing them to look increasingly weak. That's called pro-cyclical effect. That's a very bad effect of mark-to-market accounting, and I'm not sure anyone ever thought that it would have the kind of effect it had, because nobody actually imagined that we would have a time when a major asset that is held by all financial institutions, and here I'm talking about mortgage-backed securities, would decline in value the way it did. But when the great bubble came to an end in 2007, all of those assets began to fall in value. All of those mortgage-backed securities began to fall in value. And the companies involved then looked weaker and weaker. So mark-to-market accounting is a good idea, certainly for assets that you are holding for trading purposes. It's also possibly a good idea when the market is relatively stable. But when the market is either falling or rising, it's highly pro-cyclical and does not give a good account of the value of a firm, of a financial firm in that kind of market. Yeah, I think it's important for some people to have deposit insurance in this country, because some people are just not comfortable making investments, choosing investments for themselves, and want to be sure that if they put $15,000 in a bank, the likelihood is they're going to be able to come out with $15,000 at the end. They can withdraw it from the bank and they will get the full $15,000 back. That's important to some people, probably a very large number of people. So we ought to have deposit insurance for people who feel comfortable only in that way, However, the trouble with deposit insurance is that it creates something called moral hazard, which means that when you put your money in a bank and you're told that the government is protecting your deposit, well, you don't care what your bank does with that money, because there's no chance that you're going to lose the money because of bad investments that are made by the bank. So because deposit insurance creates moral hazard, we ought to cut it back rather than extending it, rather than making it a larger amount rather than a smaller amount. Now, deposit insurance, when it was first put in place, was very small, several $1,000s. And then it went to $15,000, and then it went to $100,000 in 1980, and now it's about $250,000. So the larger deposit insurance gets, the less market discipline there is exercised by depositors, because if you've deposited $250,000 in the bank, you don't really care whether the bank is using it properly, because you know the government will pay you off if the bank gets into trouble. So we ought to reduce the significance of deposit insurance as much as we can, but make allowance for those people who need to only feel comfortable if they have put their money in a government-guaranteed account. One way to do this is to have certain kinds of retail banks, small retail banks, that make very solid kinds of loans, maybe only buy U.S. government securities, and those institutions would then take funds from the public, which are insured, and then let most other banks function on kind of a wholesale level and be watched over by the people who are their depositors, who want to be sure that they are not taking excessive risks with the deposits, because those deposits would not be backed by the government. It could, but I think that we want to be very careful about the kind of business that these firms were doing. And here we're talking about investment firms called investment banks. We're talking about investment banks. There were 5 of them that were very large: Bear Stearns, Lehman Brothers, Merrill Lynch, Goldman Sachs, and Morgan Stanley. Those 5 firms together would probably be close to $2.5 trillion in assets. So they were very, very large. They were rivals for the biggest banks in the country at the time. Now, they had very high leverage, something like 30 to 1. This was historically true of these firms. This is not just before the financial crisis. They had always had high leverage because they followed a different business model from ordinary banks. They were not the kind of commercial bank that takes deposits and makes long-term loans. They collected their money by issuing securities in the capital markets, using very frequently various kinds of collateralized borrowing techniques. And when they did that, they then used that money to trade. They would buy securities, and they would trade those securities. So they had short-term assets and short-term liabilities. And if that's your business model, a very high leverage is not unusual. In fact, because the spreads on trading are so narrow, so small, to be profitable, you have to have a fairly high leverage. Now, that meant that their creditors and their shareholders had to look more carefully at them to monitor them. And over many, many years, they did. The creditors were monitoring what these 5 investment banks did. But what happened in 2008 was a completely unprecedented event. And that kind of business model where you are not protected in some way by the government, but have high leverage, was just not able to sustain itself in what turned into, after Lehman's failure, what turned into a panic, an investor panic. Nobody was willing to invest in any of these institutions unless they had some sort of government backing. So this happens from time to time. This was the first investor panic that of this size and dimension that we've had since the Great Depression, and maybe since 1907, the Panic of 1907. The Great Depression might have been a good example, but the Panic of 1907 was probably closer to what happened in 2008. And so it happens that there are turns in the economy that causes some business models to fail. And I think that's what happened to the investment banks. The point here is that every kind of business is structured to deal with the usual ups and downs that occur in the financial world. 5% up and 5% down and that kind of thing. No one is structured to deal with a financial panic of the kind we had in 2008. Well, you know, if they had passed them on to their customers, then they wouldn't have been in trouble. They might have had a lot of angry customers, but in fact, they held them, and that's because they thought they were really good investments. And so people who argue that the banks knew that these were bad mortgages can't also argue that the customers alone were the ones who were harmed. The banks themselves were harmed because they held on to these mortgages believing that the mortgages were good quality and would be profitable for them to hold over time. It just doesn't wash. You cannot blame the banks and say they knew what they were doing when they got into such trouble from holding these mortgages themselves. If they knew what they were doing, what they would have done was gotten rid of these mortgages as fast as they possibly could, and they didn't do that. No, I don't think they were, and that is a major factor in what happened in 2008. If people know what is going on in the market, they can make the right decisions. And in the case, for example, of the investment banks, their investors and their managements would want to reduce their leverage and not take so many risks if they understood how many non-traditional mortgages, subprime and other low-quality mortgages, were outstanding. Nobody actually understood this. Nobody knew it because Fannie and Freddie did not disclose the number of subprime mortgages that they were holding. Now, I must say, there isn't any legal definition of a subprime mortgage. I think, and the federal regulators of banks believe, that a subprime mortgage is any mortgage with a borrower who has a FICO score of less than 660. That's commonly the standard that is used by the federal regulators. But no one is legally required to use that standard. And Fannie and Freddie used their own standard. Their standard was a subprime mortgage is a mortgage that we have bought from a subprime originator, from a subprime lender. If we didn't buy it from a subprime lender, even if it is a subprime mortgage, it's not a subprime mortgage. And that is how they reported things to the public. And they also reported their mortgages every period, probably every quarter, to various aggregators of mortgage information. There are a lot of those in the market, and they accept information from Fannie and Freddie and from other originators and banks and others, and then they put out studies or reports that show how many prime mortgages are outstanding and how many subprime mortgages are outstanding. Well, when Fannie and Freddie reported to these aggregators that they had made X number of mortgages, they didn't report that many of those mortgages that they had made and many of the mortgages that they had securitized were subprime. They just referred to them as mortgages having been made, and oh yes, there are these subprime mortgages that we bought from subprime lenders. Oh yes, those you should put in the subprime category. But the rest of them they didn't say anything about, even though they were of low quality, or they were subprime as I defined them, as made to people who had blemished credit. So the people who watch the market carefully and decide what risks are being taken by their firms, or what risks are being taken by investors and so forth, and advise investors, were unable to see that by 2008 there were 27 million subprime and other low-quality mortgages outstanding. They just had no idea. They thought there was a very small number of these mortgages outstanding. If they had known that half of all mortgages were subprime or otherwise weak, risky, then their decisions about whether to buy mortgages, whether to stay in the market, whether to participate at all in the subprime business would have been considerably different. But that's one of the things that characterized this crisis. No one knew before it began where the risks really were and how many subprime and other low-quality mortgages were outstanding. If they had known, we probably wouldn't have had a crisis, because people would have pulled out of the market well before, saying, hey, this is too risky, there are too many bad mortgages here, and if the housing prices stop going up, many of these mortgages are going to start failing, and it's going to be a catastrophe. That is not the information that people had before them. So one of the very, very important things about this financial crisis is the lack of information to everyone who is participating, and that's one of the reasons why the major banks, major investment banks, all held on to so many of these very weak mortgages. They did not understand that they were not the only ones who were holding these mortgages, that not only were other banks and investment banks holding them, but enormous numbers of people around the world were also holding subprime and more subprime and other low-quality mortgages, and Fannie and Freddie, the major investors in the entire business, were holding or had guaranteed an enormous number of subprime and other low-quality mortgages. Glass-Steagall has been cited from the beginning as the reason for the financial crisis. This is mostly done by people who don't know a thing about Glass-Steagall. Glass-Steagall was very simple. Glass-Steagall had two elements to it. One was that banks could not engage in underwriting or dealing in securities, and the other was banks could not be affiliated with companies that were engaged in underwriting or dealing in securities. In 1999, a law was passed, the Gramm-Leach-Bliley Act, and that law repealed the second of those two requirements. That is, banks could, from that point on, be affiliated with firms that were engaged in underwriting and dealing in securities, but it retained the original portion and the more important portion of Glass-Steagall, which is that banks themselves could not underwrite and deal in securities. Now, if we look at what happened in the financial crisis, we can see that Glass-Steagall was completely irrelevant. If Glass-Steagall had remained in effect, the same thing would have occurred, because the banks got into trouble because they bought and held very poor quality mortgages, and the investment banks that could have been affiliated with the banks that got into trouble, such as Citibank and J.P. Morgan Chase and Bank of America and so forth. The investment banks that got into trouble, and here we're talking about Lehman Brothers, Bear Stearns, Merrill Lynch, Goldman Sachs, all of them were not affiliated in any way with banks. So Glass-Steagall was completely irrelevant. They both got into trouble from dealing with the same kind of assets. Those were mortgage-backed securities. One of the reasons they got into trouble was because they didn't know, the rest of us didn't know, how many of those mortgage-backed securities were actually outstanding, and because of the fact that mark-to-market accounting was required for all of them. And as the value of mortgage-backed securities fell with housing prices, as the bubble deflated, they looked weak and insolvent, just like the banks did. But it had nothing to do at all with Glass-Steagall. But it's a very easy thing to say to people that it was Glass-Steagall. Most people don't know anything about what Glass-Steagall was, and it sounds as though it really was a significant step by Congress in eliminating the Glass-Steagall Act. It didn't eliminate the act, as I suggested, and it really had no effect whatsoever on the financial crisis. Sarbanes-Oxley was adopted many years before the financial crisis came out, and it imposed many new costs on corporations, not just financial corporations, but all corporations, requiring them to, for example, have independent directors, and requiring certain changes in their accounting, gave the accountants much more authority over financial reporting. Lots of things that were very expensive for corporations, but did not do anything, obviously, to prevent the financial crisis. And so I think the Sarbanes-Oxley Act is largely irrelevant to this, except for the fact that lots of statements were made by people in Congress and in the media at the time the Sarbanes-Oxley Act was passed that this would provide for much better accounting and reduce the likelihood that there would be corporate failures. It had no such effect. The rating agencies are something of a puzzle, but I think we can understand somehow why they failed as they did. First of all, there was an information problem. They didn't know how many subprime and other low-quality mortgages were outstanding. And also, they were statistical rating agencies. This is something that many people don't really understand. They never looked at the quality of the mortgages. That is, they didn't go back and determine whether the mortgages that were shown to them by various people who were asking them to put a rating on those mortgages, they didn't go back and do another underwriting to determine whether those were good quality mortgages. They were told certain things about the mortgages, and according to the statistical background that they used, there were very few failures that were going to be as sizable as the ones that actually occurred in 2008. There would be failures, but those failures were 2 or 3% of mortgages. The losses would be about 2 or 3%. That's what historically they had been. And so the rating agencies, I think, were kind of fooled by the history of mortgages in the United States, and in a way, they were using statistical histories that didn't reflect the reality of the mortgage market at the time they were making these ratings. I'm not one who believes that the Federal Reserve's monetary policies in the early 2000s were responsible for the financial crisis in any significant way. I agree that low interest rates can build a bubble, and low interest rates may well have had something to do with the housing bubble that developed between about 2000. Well, it started in 1997 and then went through 2007, that 10-year housing bubble. But I want to talk about the period during the early 2000s because it's very important to think about it the right way. Let's talk first about a bubble. Low interest rates can cause the development of a bubble. There's no question about it. But there isn't, in my mind, any causal connection between low interest rates and poor quality mortgages. It is the creation, fostering of the poor quality mortgages that made the bubble so dangerous. If we had had a bubble in which, driven perhaps by monetary policy, in which the mortgages were prime mortgages, that is, mortgages with 10 to 20% down payments, made to people with good credit ratings, well, even if the bubble had deflated and housing prices had fallen, there wouldn't have been the kinds of defaults that we're talking about here. The defaults would have been many fewer. And as a result of that, we wouldn't have had the weakening of financial institutions, and we wouldn't have had the financial crisis that ultimately resulted and the recession that followed that. So it is not, in my view, the monetary policy of the United States in the early 2000s that was responsible for the financial crisis. Now, there's one demonstration, I think, that one can easily see that seems to me to be very strong evidence or even proof of that proposition. If you look at the data for the beginnings of the of the housing bubble, which was about 1997, for 3 or 4 years getting up to about the year 2000, that bubble is growing very sharply, and yet the monetary policy of the United States was not particularly accommodative at that time. It didn't become accommodative until about 2001, after the collapse of the so-called dot-com bubble. Then the Federal Reserve was afraid at that point of deflation, and so to avoid deflation, it did adopt a very accommodative monetary policy, and that lasted for 2 or 3 years after 2001. But the actual bubble, which contained, even in 1997, many low-quality mortgages, began well before that accommodative monetary policy. So I think the bubble itself was really caused by the amount of money that the U.S. government, through Fannie Mae and Freddie Mac, was pouring into the housing market. And it might have been advanced in some way by the monetary policy, but the bubble, I think, was really the product of what the U.S. government was pouring into the housing market, and not the Fed's accommodative monetary policy in the early 2000s.